Gold doesn't usually whisper when everything is fine. It doesn't drift politely, waiting for economists to agree on a narrative. It moves when stress is building faster than the public can process. And right now, one number is breaking normal expectations. Gold trading around $4,162 an ounce. That is not a casual price. That is a statement stamped into the market in real time. Here's the part that compresses time. Not months, not weeks. Because when the machinery underneath the financial system starts to grind, the decisions don't wait for morning talk shows. They happen in conference calls and margin departments and risk committees and in the quiet math of futures curves. And this is where the impossibility claim shows up. They said an intermeeting move was a once-in-a-generation event. They said it was a relic of crises past. They said the system was better capitalized, better supervised, better prepared. Yet the way gold is behaving right now looks less like optimism and more like institutions preparing for a sudden change in the cost of money. Most people see a price chart. Institutions see a signal. And that split matters because it reveals urgency before urgency becomes official. 75% range. But 2 members dissented. 2? They wanted a cut immediately by 25 basis points. In a world where central banks try to speak with one voice, dissents are not noise. They are a crack in the wall. What I'm about to lay out isn't a prediction. It's a pattern. It's how markets behave when policy, liquidity, and fear start moving out of sync. And if you follow the numbers instead of the headlines, the numbers are saying something uncomfortable. Gold markets are pricing stress, and stress is what forces emergency decisions. Welcome to Signal Ledger, where we decode what matters before it becomes the storyline. If you like calm, data-driven analysis that connects dots without the hype, stay close. And if you're listening from somewhere in the world right now, drop a comment with your city or country. It helps me see where this conversation is landing, and it helps the community understand how global this moment really is. Now let's reconstruct the event, piece by piece, the way a risk desk would. Start with that January 28th decision. A steady rate range on paper suggests patience, but dissents for an immediate cut suggests something else. Concern that waiting could be costly. The market doesn't need a press conference to do the math. If policymakers are already split on whether to ease, it means the debate inside the building is no longer theoretical. It's about conditions they can see in real time. Then look at the gold complex, because gold is a strange messenger. It doesn't pay a coupon. It doesn't have earnings. It just reflects the price of trust. When trust in currency purchasing power falls, gold rises. When trust in financial plumbing falls, gold can also rise, even if inflation isn't the immediate story. That's why gold often moves ahead of what the public thinks the problem is. And then there's the forensic detail hiding in the futures market. On February 6, 2026, COMEX gold futures volume ran about 197,115 contracts. Open interest sat around 407,179 contracts. 3 days later, on February 9th, open interest was around 400,187. Those numbers matter because open interest is the size of the loaded spring. It's how many claims, obligations, hedges, and bets are sitting on the table at once. When open interest is that large, small shifts in margin requirements, collateral haircuts, or funding costs can produce sudden forced behavior. Not because everyone changes their mind, but because the rules change under their feet. There's another layer to the institutional movement that rarely gets discussed in plain language: the difference between owning exposure and owning settlement. A macro fund can buy a futures contract and feel hedged, but that hedge is only as smooth as the clearing system that stands between counterparties. A central bank buying bars is operating in a different universe. That's why, in the same week, paper positioning can churn while official accumulation stays steady. Look at the cast of institutions that touch this market. You have primary dealers financing inventories in the repo market. You have bullion banks making markets in forwards and swaps. You have large ETFs creating and redeeming shares through authorized participants. You have refiners and fabricators who care about physical flow, not screens. And you have sovereign buyers who don't announce a trade. They just change the composition of reserves over time. When stress rises, the coordination isn't a secret meeting, it's timing. If funding gets tight, dealers reduce balance sheet usage. If dealers reduce balance sheet, bid-ask, spreads widen and liquidity thins. If liquidity thins, volatility rises. If volatility rises, margins rise. And when margins rise, leveraged positions shrink. That entire chain can unfold before a single headline admits anything has changed. This is why the repo market matters, even if you've never traded repo in your life. In September 2019, short-term repo rates briefly spiked to around 10% during a funding squeeze. It wasn't a recession headline, it was plumbing. The response was not a speech, it was liquidity operations, because the system needed cash against collateral to keep functioning. The lesson was simple. You can have calm growth data and still have stress in the pipes. March 2020 made the lesson louder. Even US Treasuries, the so-called deepest market on Earth, showed signs of dysfunction as participants scrambled for dollars, spreads widened, dealers stepped back, and the Fed expanded facilities to restore functioning. That episode is why markets take the possibility of fast policy action seriously. It's not about optimism, it's about preventing a seizure. Now bring that back to gold. If there is a squeeze for dollars, gold can do two things at once. It can get sold temporarily as a source of liquidity, and it can get bought aggressively as protection against the policy response that follows the squeeze. That paradox creates violent swings. It's the reason safe haven can still drop on the day fear peaks, and then surge when the second-order consequences become clear. So when you hear gold is up, the more precise translation is the cost of certainty is rising. And inside the futures market, settlement rules shape behavior. Most contracts never go to delivery, but the option to demand delivery is what anchors credibility. When fear rises, more participants care about the fine print. What qualifies as deliverable, how quickly metal can be sourced, and how spreads behave between futures, spot, and swaps. When those spreads widen, it's a sign the system is paying extra for immediacy. So here's the central mystery. If policy is stable, why is gold behaving like policy is about to move? If the economy is fine, why are institutions leaning into protection that has historically been associated with stress? And if everything is contained, why does the positioning in paper gold look like it could turn into a scramble? To answer that, you have to step back and see the hidden pattern that repeats across decades. In 2008, the story was not supposed to end with emergency action. The official narrative talked about a housing downturn, some contained losses, and a few fragile lenders. Then the plumbing tightened. Funding markets started refusing to roll. The Fed didn't wait for scheduled meetings to respond. Intermeeting moves became the language of necessity, not preference. Result, the cost of money dropped fast, and markets convulsed anyway because the damage was already inside the pipes. In 2020, the story was not supposed to require an emergency cut either. The public saw a health shock. Markets saw an immediate liquidity shock. The Fed cut rates between meetings, then expanded facilities to keep credit flowing. Result, risk assets crashed, then rebounded, but the key takeaway wasn't the rebound. It was that the Fed moved when market functioning, not just growth forecasts, was at risk. Now in 2026, the pattern isn't identical in cause, but it rhymes in mechanics. You can have a world where inflation prints look calmer, and yet liquidity conditions tighten. You can have a world where employment looks okay, and yet credit spreads start to behave like something is wrong. You can have a world where the policy rate is on hold, and yet the internal debate is already tilting toward easing because something sensitive is flashing red. Gold doesn't need to know which headline will dominate next week. It just reacts to the shape of risk. So who are the players moving first? Start with central banks because they are not trading for clicks. They are managing reserves, legitimacy, and long cycles. In the fourth quarter of 2025, central banks were net buyers of about 230 tons of gold. In the third quarter, that number was about 218 tons. That's a 6% increase quarter over quarter. When official institutions are adding that much metal, they are not chasing a meme. They are diversifying away from something, quietly, for reasons that are rarely explained in a soundbite. Then look at the big pools of capital that live in derivatives. Futures and options are not a sideshow. They are where leverage concentrates, where margin dictates behavior, and where stress reveals itself early. With open interest around 407,179 contracts on February 6th, you're looking at a market that can absorb hedging, yes, but also a market that can be forced into cascading adjustments if volatility spikes. Now layer in the exchange, the clearinghouse, and the margin desk. This is where the how matters. A margin change is not a headline. When volatility rises, clearinghouses can raise margin requirements to protect the system. That sounds prudent. But raising margin in a volatile market is like tightening a seatbelt during a sudden swerve. It can save you, but it can also force you to slam the brakes. Participants who can't post more collateral have to reduce positions. That reduction can push prices, which raises volatility, which justifies more margin. That's how spirals begin without anyone intending them. Here's where it gets interesting. Gold is often described as a safe haven, but the paper gold market can behave like a risk asset under stress because of margin. If leveraged participants are forced to sell to meet collateral demands, you can get sharp drops even in an environment where long-term demand is rising. Those moves make perfect sense if you're thinking about collateral calls. Now let's talk about the dislocation, because this is the part most people miss. There are two gold markets living on top of each other. One is the paper market, where contracts are traded in massive size, where open interest can be enormous, and where most positions are closed out or rolled rather than delivered. The other is the physical market, where bars move, where vault inventories matter, and where delivery constraints can show up as premiums and delays. When everything is calm, these markets stay aligned. When stress builds, they can diverge. Paper can be pushed around by leverage and margin. Physical can stay tight because actual supply takes time to move, and because real buyers, especially official ones, don't care about intraday noise. This is why the phrase paper versus physical isn't a conspiracy. It's structure, and structure becomes visible when the system is strained. Now look at the contradiction again. If the Fed is truly comfortable holding steady, gold should not need to be repriced to nearly $4,962 an ounce in a way that feels urgent. If liquidity is abundant, hedging demand should be orderly, not explosive. If the world is confident in the smooth functioning of credit, the market wouldn't be building such a large, active stack of claims in the futures complex. So what evidence can we point to in numbers that this isn't just mood? First, the policy signal. 75% with 2 dissents for an immediate 25 basis point cut. That's the kind of detail that matters because it reveals how close the committee is to moving even without a scheduled meeting. Second, the futures load. February 6th, volume about 197,115 contracts, open interest around 407,179. February 9th, open interest around 487. Those are not small changes. They're a snapshot of a market with enormous outstanding exposure. Third, the official accumulation. Q4 2025, net central bank gold demand about 230 tons, up from 218 tons in Q3. That is a steady, persistent bid that doesn't disappear because a chart wobbles. When you put those together, you get a picture of a system where official institutions are buying physical reserves, while leveraged markets are carrying a huge paper structure, while policymakers are showing signs of internal urgency. That combination has shown up before, and it tends to lead to the same family of outcomes. Outcome one is a funding scare. Something in the short-term funding world tightens. It can be repo, it can be bank balance sheet constraints, it can be a sudden rise in collateral, haircuts, or it can be credit spreads widening in a way that breaks a popular carry trade. When that happens, selling becomes mechanical. It's not about belief, it's about balance sheets. Outcome two is an unexpected policy response, not because the Fed wants to surprise, but because the market is forcing speed. Emergency moves are rarely about making investors happy. They are about restoring function, preventing a feedback loop, and making sure the payments system doesn't seize. Outcome three is a repricing across assets. If the cost of money shifts suddenly, it changes the discount rate. It changes risk appetite. It changes what leverage can survive. That's when you see correlations that were stable suddenly flip. So how could an emergency move actually happen from here, mechanically, without drama? Imagine a crowded theater where everyone is standing on the same narrow balcony. The balcony is leverage. The building is the financial system. If the floor shakes, people don't calmly file out. They move fast, and they push in the same direction. A funding shock is that shake. The moment short-term money gets nervous, the price of liquidity rises. Banks become selective. Dealers widen spreads. Clearinghouses protect themselves. Margin goes up. Then leveraged participants sell what they can, not what they want to. Often that means selling the most liquid positions first. That can include gold futures, even if the long-term thesis is bullish. The public sees a drop and thinks the story is over. The institution sees a forced liquidation and thinks the story is beginning. Because after forced selling, the next phase is rehedging. The same desks that sold to meet margin now need protection against the deeper problem that caused the shake. That's when gold can rebound violently, not as a feel-good story, but as a scramble to restore hedges. Now connect that back to the Fed. The Fed doesn't react to gold directly. It reacts to conditions that gold may be sniffing out: tightening liquidity, stressed funding, impaired market function. A split committee with dissents for an immediate cut tells you that some members are already seeing conditions that argue for easing sooner rather than later. And markets are brutal at one thing. They will price the possibility before it becomes the policy. This is also where expert contradictions become the fuel. Each of those might contain a piece of truth, but the data points we're looking at suggest a deeper, more mechanical layer. Gold is responding to the probability of a sudden shift in liquidity conditions. It's not a story about one cause. It's a story about an ecosystem moving out of balance. Now let's simplify the mechanism without dumbing it down. Think of the financial system like a highway system. Interest rates are the speed limit. Liquidity is the number of lanes open. Leverage is the number of trucks on the road. Margin is the rule that says how far apart the trucks must drive. When everything is calm, lanes are open and trucks can space out. When volatility rises, the rule changes. Trucks must increase distance. That slows traffic. Some trucks can't comply because they don't have the room. They exit the highway abruptly. That exit causes congestion behind them. Congestion raises volatility. The rule tightens again. More trucks exit. In markets, exiting is selling positions to reduce risk. That selling can hit gold futures, stocks, bonds, anything liquid. The goal isn't to express a view. The goal is to survive the rule change. An emergency Fed move is like temporarily opening more lanes or lowering the speed limit in a way that prevents pileups. It doesn't fix the road. It keeps traffic from locking up. So what does this mean going forward if the pattern continues? Historically, when you see strong gold, heavy derivatives exposure, and signs of policy disagreement, you should watch for very specific indicators that tend to precede fast decisions. Watch funding stress measures. Watch whether short-term borrowing costs start acting jumpy. Watch whether credit spreads widen in a way that doesn't match the calm narrative. Watch whether volatility spikes trigger visible changes in margin requirements at exchanges and clearinghouses. Now consider scenarios, not predictions. A conservative scenario is that stress stays contained. Gold remains elevated, but volatility cools. Open interest gradually bleeds lower as participants reduce risk voluntarily. The Fed waits until a scheduled meeting and then cuts later, framing it as data dependent, even though the market priced it first. A moderate scenario is that something in funding tightens enough to force a quick response. The Fed signals readiness, perhaps through language, perhaps through facilities, perhaps through an intermeeting adjustment if conditions deteriorate quickly. Gold remains a preferred hedge, but paper markets swing violently as margin mechanics do their work. An aggressive scenario is a full feedback loop. Funding stress leads to forced selling. Forced selling leads to volatility. Volatility leads to margin hikes. Margin hikes lead to more selling, and then policy responds rapidly to stop the spiral. In that environment, the headline will sound sudden, but the pattern will not be. The question is whether the system can keep these contradictions alive without resolution. Dislocations don't last forever. Either policy and liquidity stabilize, pulling gold back into a calmer regime, or stress escalates until policy has to move faster than planned. And this is the divide. There are people who watch headlines, and there are people who watch structure. The headline tells you what already happened. Structure tells you what is likely to happen next because it reveals constraints. It shows where leverage is concentrated. It shows where collateral is tight. It shows where official buying is persistent. It shows where policy is conflicted. This isn't about being smarter. It's about paying attention to the right layer of information. Retail tends to move last, not because retail is foolish, but because retail is shown the story after the decisions are made. Institutions move when the rulebook changes, when dissents appear in a policy decision, when open interest stacks up like dry tinder, when central banks buy quietly and steadily while public debate gets loud and emotional. Gold at $4,162 an ounce isn't a guarantee of anything. It's a signal that the market is willing to pay for trust, and it's willing to pay now. 75% isn't a promise of stability when two dissents are already leaning toward a cut. A futures market carrying more than 400,000 contracts of open interest isn't inherently dangerous, but it is a structure that can become fragile if the cost of collateral changes quickly. So if you want the clean takeaway, it's this. When gold positioning and policy disagreement align, the next phase is usually speed. Either the system calms and the signals fade, or something forces a faster response than the public expects. This is Signal Ledger, where we decode what matters before its headlines. If this connected dots you hadn't seen on the same page before, you know what to do. And remember, the question isn't whether the story unfolds. The question is whether you'll recognize the pattern while it's still forming.